We are back at the Farm Financial Crisis Conference in Guelph, and now I'm joined by Greg Pate from OMAFRA. And Greg, you've been doing a little bit of work on interest rates and where interest rates could go and what impact that might have on farms. And let's talk about what you just presented. And basically, you mapped out some scenarios where, what would happen if we went from the 2% area that we're at now to 3%. What are some of the basic takeaways you learned from that work?
The basic takeaways were that in dealing with such an interest rate like that going from 2 to 3, we even looked at going up an extra percentage point on top of that. It really only had a marginal effect on producers' ability to manage and service their debt.
What about the size of farms? I think your analysis was, larger farms are going to be better able to manage that interest.
Yeah, so what we found was a lot of the larger farms, they did have, technically a lot more debt themselves, but their financial situation overall and their ability to produce a net income to service that debt was much higher than some of the smaller farms.
Yeah. Tell us more about those smaller farmers. Obviously, part of the scenario we've been in for the last while is get big. What's happening with those smaller farms from an interest rate perspective?
A lot of those smaller farms are they're being still run and managed as a business, and they should be able to manage their debt to some situation, but it appears that there is the smaller in scale group of farms that they've taken on debt, and it could foresee some issues if things don't turn around in their favor.
Right. And so a couple of other thoughts that you had really was, the bottom line, the majority of farmers still really have no debt. There's a big percentage out there with no debt, and that's a good thing.
Yeah, and when we say no debt, there is a large percentage of farmers who have no debt, and then there's a large number that also have some debt, but it's relatively small or not a really big issue for them. And so there's a lot of farms who are in quite healthy financial situations and are able to weather any potential interest rate increases.
Right. And we talked a lot about net farm income, and the bottom line is there's about 20% of farms, and we were looking at 2013 data. About 20% have negative farm income, and that may cause some issues in an interest rate hike situation.
Yeah, and looking at 2013 data, and we looked out going forward to 2015 as well, and we looked at changing the interest rates, and interest rates did have a bit of an impact, but the bigger factors seem to be actual total net income and creating an ability to service that debt. And some sectors are going to have relatively lower prices than they've had in the recent past, and that's where the numbers seem to come from, that there may be issues with servicing debt.
It really changes from sector to sector. You talk about a couple of sectors that sort of stood out on, one way or the other on your analysis.
Well, the two that I can speak to right off the top of my head is kind of looking at the beef industry. They're currently, in 2015, experience relatively high prices from an income perspective, and it really feeds through their financial information and their ability to service their debt, as opposed to, say, the field crop industry, where a lot of debt had been accumulated in the past few years, and now income's starting to decrease, and from a debt coverage ratio, it doesn't look quite as a rosy picture.
Talk about 4 or 5%. Any thoughts on where we hit the squeeze?
Yeah, my gut feeling is that if all else being the same, and just interest rates go up, by 4 or 5%, the vast majority of farms should be okay. I think the biggest factor, again, is going to be that farm income and having just an ability to pay not only interest, but all the other expenses that a farm might be incurring.
Well, hey, thank you so much for your insights today. We'll have you back on when interest rates go up and see where you think they're going then.